A warm welcome to our macro and strategy update. When we look at the world economy, one main point to notice is that the current economic recovery shows notable divergences. Advanced economies are experiencing a recovery that is much more dynamic than their emerging market peers. In tandem to this diverging economic recovery, interest rates in main advanced economies could also rise sooner, whereas conditions in many emerging market economies would call for monetary policy to remain loose. Now a look back to 2013 gives some insights. Empirical evidence, including from the IMF, shows that it is in particular the policy implications of the US Federal Reserve that has a large impact on emerging market economies. When the Fed surprises investors by announcing changes in monetary policy, this affects emerging markets. A classic example is the May 2013 episode, when Fed Chair Bernanke began to talk about when and how to reduce the central bank's bond buying program. Of note that while the impact on many emerging markets was significant, markets began to differentiate quickly between countries with good fundamentals and those that had begun to accumulate economic imbalances. Of note also that at the time, the element of taper talk surprise was important, a possible difference to the current setting. The main implications of such an episode would impact mainly fixed income securities in emerging markets. We continue to be invested in emerging market economies, while it is important to remain selective. Those economies with lower fiscal vulnerability and those that are better insulated from external shocks have a priority. We prefer emerging market bonds in hard currency relative to local currency bonds. But let's reaffirm that a repeat of the 2013 scenario is a risk, but it's not our baseline scenario. Thank you for listening, and we all wish you a very enjoyable summer.